Global finance operates on a historical reflex. When war or geopolitical panic breaks out, investors rush to safe haven assets, locking away wealth in gold. That reflex was tested overnight. The U.S. military launched a massive retaliatory strike, hitting over 80 targets across the Middle East. Under the traditional rules of the market, this level of escalation should have triggered an immediate and aggressive surge in gold prices. Instead, the market saw a total fracture. Gold breached its technical support level, dropping to $4,063 an ounce. The damage extended into the tech sector, where major giants like Amazon faced immediate and heavy sell-offs as capital fled the broader market. This creates a central mystery for the global economy. Why did a massive military escalation cause the world's primary safe havens to fracture instead of rise? To find the answer, we have to look at the geographic epicenter of the strikes, the Strait of Hormuz, where recent attacks on cargo ships have left the maritime supply chain vulnerable. This narrow passage is the most critical choke point in the global economy, responsible for the movement of the world's raw energy. The strikes triggered an immediate price reaction. Global oil surged over 3%, breaking past the $76 a barrel threshold. Expensive crude oil acts as an automatic tax on the global economy, driving up the base cost of manufacturing and shipping every physical good. This energy spike is resurrecting Wall Street's primary fear, the return of a systemic inflation crisis. The Middle East strikes have triggered an inflationary shockwave that is now rippling through the global economy. That shockwave has moved focus from the battlefield to Washington, D.C., where the Federal Reserve is forced to respond to the threat of rising costs. The Fed's primary tool for cooling inflation is the interest rate. By keeping rates elevated, they deliberately slow down economic activity to keep prices in check. Because the airstrikes threaten to reignite inflation, investors now realize the Federal Reserve will likely refuse to cut interest rates for the foreseeable future. This reality breaks the logic of gold. Paying no yield, it loses appeal when high rates offer guaranteed returns on government bonds. High-growth tech companies are crushed by the same weight. Their models rely on cheap borrowing, failing when interest rates remain high. The U.S. missiles resurrected inflation, which locked in high interest rates and poisoned the appeal of both safe haven gold and growth-heavy tech. We are witnessing a systemic rotation of global capital, not a temporary market dip. Billions of dollars are being pulled out of the growth and risk sectors that have dominated the last decade of tech dominance. This capital is migrating into tangible energy infrastructure as investors seek protection in the raw commodities that now dictate the direction of the market. This overnight fracture shows that geopolitical conflict and monetary policy are now functionally linked. A single kinetic strike in the Strait of Hormuz now dictates the Federal Reserve's domestic strategy and your personal portfolio. In a market where energy rules and tech bleeds, every investor faces a choice. Are you selling your tech bags today, or are you attempting to buy the gold dip? Let us know your strategy in the comments.